So how do you combine a Section 121, a homeowner's exemption, and a 1031 exchange, which actually is not for primary residences, and even with boot? We're going to dive into that all in this video here. My name is Tim Kraus. I'm the operations partner with Cornerstone CPA. It's my job to help translate all of this mess into something that's understandable and potentially applicable for you, and might even be applicable for your situation. It's kind of a unique situation, so let's dive right in here. So we have a client who lived in a house. We'll call this house A. Okay. And then after a little while, they decided to move, and we'll call this one house B. Okay. They turned house A into a rental. And boom. They turned house B in, or house A into a rental. Now their house A has appreciated a lot in value. Quite a bit. So now he's looking to potentially sell house A and then buy a different property, house C we'll call it here, through a 1031 exchange. Which, high level, what a 1031 exchange is, when you have a property that's gone up in value and then you sell it, you're able to take that profit, and instead of it being taxed, you're able to take it and then apply those profits into a new house. You have to do it through a 1031 company. There's a lot more details and red tape with that, but at a high level, that's what that is. So, but he would also like, it's not just a simple 1031. If it was a simple 1031, easy, no problem. But also, he would like to take some of the profit from the rental house to pay off his primary residence. And this is what is called boot. Any part that is not applied in the 1031 to property C is called boot. And there's more details on that, but that's essentially what that is. Now he wants to apply to the boot, because technically the boot is taxable because the profit's not going to property C, but he wants to apply to the boot Section 121, which is the homeowner's exemption, which because of the time he lived in the property, he should be able to apply that to then the boot to be able to cover that, so that makes it so that does not have capital gains tax on it, allowing him to pay off property B and then also sell property A to then buy property C and pay off property B. So, a few more details on that here. Just so in case you're not familiar with it, Section 121, which is also very often a homeowner's exemption, it allows you to exclude up to $250,000 of capital gains if you're single, or $500,000 if you're married filing jointly on a property you sell that is your primary residence. Now the way that they verify, at least in this section, primary residence, is that you lived in it for at least 2 out of the last 5 years. So if you had a rental that you moved out of 10 years ago, and you think you could do a Section 121 on it, you can't. They are very strict on it. It actually goes down to the number of days. It's just said 2 out of the last 5 years, but they have a day calculation on that one. So that is what he is going to be able to apply to the amount that has the boot on it. The 1031, which is a very common investor strategy, is called like-kind exchange. It lets you defer. Again, the top one lets you actually exclude. This is just defer, but then again, you could eventually die and do stepped-up basis, and you're good to go. But defer the tax on the remaining gains and roll it into another investment property. So even though the property was once his primary home, was once the client's home, it is now an investment property, which is exactly what is needed for the 1031, which is huge. Now there could be some fine details there, which we don't need to get into here, as far as in how long it has to be an investment property before you can 1031 it. But in this scenario, he can. It's looking like so far that he can actually do the 1031 and the 121. So the boot, or getting the cash out of the 1031, any cash or non-cash like property that you receive from the 1031 is called boot. Okay, normally that boot is taxable. So if he took $500,000 out and he was going to take $200,000 to property A to pay off property A, that would be taxable. But if the client qualifies under Section 121, there's an exclusion, and if the exclusion is large enough to cover the boot, then it could essentially be tax-free. The catch is that the section applies first to the realized gain, whether the portion is included or not, including depreciation recapture. So that's a little more details than we need to get into here, but essentially the 121 helps move up your basis so that if you eventually have to recapture the depreciation when you sell property C, that is helpful with that. And then if you were to walk away with more than the section 121, this individual, when he lived in the house, was single. That means he'd be qualified for $250,000 if section 121 applies. $250,000 of excluded capital gains. But let's say he wanted to take out $300,000, then that $50,000 would still be taxable. It depends on the size of how big of a boot he needs to take in this scenario. So, if you're able to do this, it means that you moved out of you had a primary residence, then you turned into a rental, and then over the next couple of years you decided, you know what, I want to sell that rental. Okay, well, you might then be able to do, you definitely be able to do then a 1031, but if it's within the time frame of 2 out of the last 5 years since you've been there, then, so less than 3 years ago, then you'd probably be able to do a section 121 as well, which could really help you out as far as in if you wanted to take out boot, or if you just wanted to have that stepped up basis moving on to property C, which we're not going to get into here, but that all depends if you eventually plan on selling property C. If you plan on never selling property C and eventually moving to property D and etc., and then eventually dying, don't worry about that. That's a different tax piece, and you'll be able to do the 1031 essentially till the cows come home. But if you fall into this situation where you have a 1031, you want to get some money out, and also you lived in there 2 out of the past 5 years, this could be a strategy for you. So, questions about this if you have questions about this strategy or how to apply it on your own real estate, please leave it in the comments, let me know, or reach out. We'd love to talk to you about it. My name is Tim Kraus with Cornerstone CPA. We do bookkeeping, tax, and tax planning for a lot of real estate clients and a lot of real estate investors. Please have a good one. Bye.